Good evening and welcome to this special Taxsutra Hangout on the newly notified tax accounting standards. The Government of India on April 1 notified the Income Computation and Disclosure Standards, the abbreviation as ICDS, also called as Tax Accounting Standards. These become effective from April 1, 2015, and they apply to all the taxpayers who are following mercantile system of accounting. This potentially is going to have a significant impact on several taxpayers filing tax returns in this country. And to discuss the nuances of the ICDS that government has notified, we have two leading professionals in the country. Let me introduce you to my panel for the evening. Mr. PR Ramesh, Chairman Deloitte India, joining us from Mumbai, and Mr. R Sekar, Senior Tax Partner from Deloitte, joining us from Bangalore. Gentlemen, thank you so much for joining on this Tax Sutra Hangout. And Mr. PR Ramesh, your initial reaction, you've seen development of accounting standards in India in last several decades. The Indian gap, as we call them, then you've seen the international gap, and now you have, let me use a crude word, a tax gap or a tax accounting standards. What is your initial reaction after looking at the text of these 10 notified accounting standards?
See, my initial reaction is that these standards are actually unnecessary. First of all, the stated objective was to eliminate, shall I say, options. The stated objective was to tax real income, as if financial reporting is not of real income. And the stated objective is to avoid two sets of books. If you really look at financial reporting, 4 sets of standards are required. You require accounting standards, you require actuarial standards if you really are looking at actuarial valuation, you will require costing standards when you are looking at costing of inventories, and you will require valuation standards when you are on to fair value of many items. So conceptually, if you want to lay down standards and apply it in financial reporting, you need these 4 sets of standards. Now, merely by introducing accounting standards for taxation, what about the other 3 standards? What about actuarial? What about costing? What about fair value? Would tax department get into notifying how fair valuation is to be done? Will they get into saying how costing is to be done, or how actuarial valuations to be done, and what sort of assumptions are to be maintained? I think they are entering into an arena where they will not be able to play, because accounting standards are increasingly changing to keep up with the newer business structures which come in, or to address changes to accounting principles which are necessary on account of changes in the businesses and in reporting requirements. When we move on from a current accounting standards to Ind AS, the gap between ICDS and the Ind AS will be even more wider, because international accounting standards has the principles of time value of money, has the principle of constructive obligation, has the principle very effectively of substance over form, effective rate of interest, useful life of assets, amortization, whole host of concepts which will be there, which are not addressed in ICDS. So the gap is going to be wider, and I don't see what purpose is achieved. And the last point I would like to make is, if it is to bring about certainty as they claim, in the current income tax law itself, Sekar is the expert on it, not me, but different courts interpret the same law differently. Tribunals interpret the same law differently. There is no finality to interpretations in many cases. So when there is that sort of a volatile environment, adding further volatility in somebody interpreting accounting standards, using the same text, I'm sure different courts or different tribunals will interpret accounting standards now differently. So we are only adding to the chaos rather than reducing the chaos.
Right. Mr. Sekar, you've seen the tax law evolve for last several decades. Government calls it as tax accounting standards. Do you think that it's just an accounting standard, or it's more a substantive tax provision? How do you look at it?
Okay, Amaya, thanks for that point. In fact, my views is a little bit no way different from PRR's view also. The way I look at it is that income tax, right from the day the jurisprudence has been evolved in income tax, is that the tax computation follows the accounting principles laid down by the experts. If you go back to Supreme Court decision first in Challapalli Sugars, where when we talked about the income earned during the correction period, Supreme Court very clearly said the accounting principles are supreme. Standards laid by ICA are supreme. The Supreme Court laid down the principle. There are enough judicial precedents where Supreme Court said that the tax computation shall follow the accounting principles unless the provisions of the tax override the accounting principles. Therefore, the fundamental rule is that the tax computation follows the accounting principles, except where it is very specifically provided in the Act. Second one, there is a provision under the Act under Section 145 which says that accounting standards shall be notified. My only point is that why Income Tax Department or CBDT should getting into the notification of tax accounting standards when there is an expert body already constituted by the Government of India under a different legislation under Companies Act as already notifying the accounting standards which are required to be followed by the corporates. They need to say only one thing: what are the accounting standards notified under the Companies Act is also meant for the tax purposes. That would sort out multiple issues like interpretation of accounting standards, differential treatment between ICDS and Ind AS and IFRS. It avoids a multiplicity of issues. Third, if the income tax is only on the revenue, ultimately every corporate will have to follow a mercantile system of accounting or accrual system of accounting, as you call. The method of mercantile or the method of accrual cannot be different for tax purposes or for the books purposes. What would happen? It is only a treatment of few items here and there. A mere timing differences on certain items is not going to affect the taxpayer revenue or the tax department collection. So I don't foresee a significant objective being achieved by the tax department and introduction of tax accounting standards except in cases compliances. The second point which you made, is it going to be a provisions of the Act or is it going to be a part of the Act? Wait, I read the preamble and I read the provisions of the ICDS that it is part of the Act, except they made it very, very clear. If there is a conflict between the provisions of the Act and provisions of ICDS, provisions of the Act shall be overriding effect on that. Now again you will have a challenge. You will start interpreting the provisions of the ICDS and provisions of the Act to ensure which is supreme over the other, which is needless at this point of time, Amaya. That's all my limited point.
Right. Mr. Ramesh, if you look at the preamble to the tax accounting standards, it very clearly says that it states that separate books of accounts is not envisaged for implementation of these notified tax accounting standards. If you look at the details of all of these standards, there is a elaborate code which is specified in each of these standards, and of course the disclosure requirements. Do you think that practically a corporate will be able to just do an out-of-book adjustment to give effect to the tax accounting standards, or these accounting standards call for sort of virtually recreating another parallel set of accounts?
In my view, it will recreate another parallel set of accounts, because if you see some of the requirements in the ICDS, the Income Computation and Disclosure Standards, take the first one, where foreign exchange is only allowable on settlement.
Yeah.
Now, let's assume we have a forex liability which goes on for 10 years. Part gets to capital, maybe some part may be going to revenue, whatever it may be. You look at the effect of it. To unwind the effect of each of these, including forex derivatives, etc., and keep separate track for tax purposes what is settled and what is not settled, and the consequential impact on depreciation on assets. I know the tax value of assets in any case is different, but still that is one aspect of it. The second is, take the requirement which says that a percentage of completion will be the only method and not completed contracts method.
Right.
Now, that is fundamental to accounting, which lays down the conditions on the which are required to be fulfilled before you apply percentage completion method. Otherwise, you cannot apply percentage completion method. You have to apply completed contracts method. Now, those two are chalk and cheese. How will you maintain that sort of tracking mechanism? Outside the books is all right for a mom and pop store. But if it's not a mom and pop store, it's a large multi-division, multi-location company, it's nightmarish.
Right, right. No, that actually summarizes the concerns that's expressed by several corporates as well. Mr. Ramesh, have you seen similar provisions in any other countries, be it in Asia or in Europe or in Americas, wherein this?
No, not to my knowledge, not as tax. You see, it is quite, in some countries, tax may be on local GAAP as opposed to international standards. But that's a different basis than tax department trying to come up with its own set of standards, and I don't even know whether they have a mechanism to update the standards for current principles. We will come up with newer standards and newer subjects. We will modify existing standards. The current standard on property, plant, and equipment will change. The current standard in many other areas, there are many other current standards which are in the process of being revised and made applicable for all. Now, I don't even know whether the tax department will come up with the same pace as the Institute of Chartered Accountants and the National Advisory Committee on Accounting Standards does insofar as revising standards is concerned.
Right. Mr. Sekar, again, a fundamental point on the tax structure, the way the statutes are made in this country. We follow democracy and parliament system where laws get enacted, passed by the parliament. You have notifications, which is through a delegated legislation authority. Certain notifications are issued on specified provisions. Now, one of the points of view that has been expressed is that the tax accounting standards actually give a handle to the CBDT to notify and make fundamental changes in the way the income is computed. And take for an example, the valuation of securities. There's a fundamental change proposed of category-wise approach to value the shares, for example. That has a significant impact on the tax liability of a taxpayer, and this is going to happen without following the parliament process through the delegated legislation of a notification. So is this a right trend that this government is setting, Mr. Sekar? I mean, as I said, this is going back to the fundamentals of levy of tax. That is it through an appropriate legislation? Your comment, sir?
Yeah, so 145 which are to be in line with the computation principles under Section 5 to Section 9. If the notification of accounting standard under Section 145 changes the basis of computation under the Income Tax Act itself, then certainly it is a backdoor entry. And certainly, though the government has got power to notify, but through a notification changing the method of computation is not appropriate. And accounting standards coming through, and particularly issuing through an accounting standards and making a changes in the computation basis, or recharacterizing a capital versus revenue, as Ramesh was putting it across on 40A, as well as on the completed contract versus percentage completion, recasting the entire computation with changing the methodology of computation, so the notification is inappropriate in my view, Amit.
Right, right. No, that's very interesting comment, Mr. Sekar. Coming to the specific issues that arise from the standards, and we'll discuss some of the issues. But I'm specifically looking at ICDS 1 preamble, and it states that the treatment and presentation of transactions and events shall be governed by their substance and not merely by the legal form. This, in the context of an accounting standard, perhaps seems it's not new. But in the context of tax accounting standards, do you think that this potentially creates a risk, and giving sort of an option to the assessing officer to sort of imply GAR while applying tax accounting standards? Mr.
No,
Sekar?
absolutely. Yeah, absolutely. No, there's no comparison between GAR and ICDS. Probably merely use of the word substance over the form. We, right or wrong, we get scared about the substance over form to the overemphasis of GAR. But I don't think there's any near to the GAR. But as you know, probably Ramesh is the right person when we talk about an accounting side. In any accounting, probably the substance of the nature of transaction is very critical rather than the form of the transaction when it comes to an accounting. And that's the reason, that's the basis of the accounting for any transaction. And when you talk about accounting standards, be it tax size accounting standards or any accounting standards, the substance of the transaction for the purpose of accounting should be looked at it. So in a way, the substance of the transaction should be looked at. If you look at what are the ICDs that has been notified, they take into a substance and they put the principles which has been pronounced by the courts in various circumstances and various parameters. So I don't think GAR is coming up or it is anyway related to the GAR. Accounting is based upon a substance of the transaction. That's the way I put it across. In fact, Ramesh is the right person to talk about accounting and substance. But from a tax perspective, I don't think GAR is even near to that. I don't want to create that sort of position that ICDS is another form of a GAR, which is not correct.
All right. Mr. Ramesh, your point, of course, in accounting, substance is the key, and in fact, IFRS is taking to the next level in terms of fair value reporting, and is ICDS sort of widening this gap, or we see tax getting closer to the accounts?
Well, I'm not sure ICDS will widen the gap by stating substance over form. My concern is ICDS will not be able to implement substance over form as it is recognized in accounting. At the most, ICDS is more aligned, maybe I'm not the expert again, like a McDowell case sort of a situation where you really look at what is the substance of the arrangement as opposed to the form of the arrangement, etc. But if you look at accounting, let me give you, let's say, two instances of substance over form. Take the first instance which I can give you is finance leases or arrangements in the nature of a lease. In an arrangement in the nature of a lease which is coming up in the Ind AS or IFRS standards, you have put up, let's say, a power plant in a steel company's premises and which is exclusively used to generate power for supply to the steel company. And the way the arrangement is, in reality, that power is not supplied to anybody else. So that asset will sit in the steel company's books even though it is owned by the power company. Because in substance, it is a lease, a finance lease. And therefore, because you can't move the steel power plant out of the steel company, right? So look at the substance and look at who's the owner. Currently, it will all be in the books of NTPC, not in SAIL maybe. But when you apply the new standard, a lot of assets could move from NTPC to SAIL perhaps. I'm just saying. Will tax recognize this? Will tax the owner is different and something else? Because here it is a certain arrangement? The answer is no. The tax will not recognize the subject. Take the second case, the agency issue which we have in many cases, where you are in a way gross or net is the issue. Is your revenue gross or is your revenue net? Whether you are acting as an agent or acting as a principal. There in a large basis, we will look at the substance and have the net accounting. If you don't have the inventory risk, if you don't have the credit risk, if you don't have many other risks, you don't have any obligation, you are in substance an agent. There's a lot of decision making which arises in those situations. I'm not sure whether tax department will accept those. They would perhaps go on the basis of the form. And a lot I'm seeing where in form there is service tax paid, there is sales tax paid on the sale, but we do not recognize that in accounting because we say this is not, you are just an agent. So merely because you are paying a certain tax doesn't mean it's a sale of the full amount you should recognize. So these challenges I definitely see. I don't see tax department coming closer to accounting in this way.
Mr. Sekar, quick comments on this before we move to the next point.
Yeah, in fact, I mean, I'll just add up to what Ramesh says. Ramesh's point is perfectly valid from accounting perspective as well as from the tax angle. But nowhere the ICDS, which has been talked about it, when it comes to being a revenue recognition, or when it comes to a, today we are talking about 10 accounting standards, accounting for leases or accounting of certain type of income has not been noted. What you're talking about today from a revenue recognition perspective. From a revenue recognition perspective, it merely gives an indication how the revenue to be recognized when there's a certainty of the transaction, there's no uncertainty. That's all mere indication. A substance over form, it's purely recognized in a guidance perspective, but not as a form of implementing when it comes to recognizing a particular income or a particular expenditure. And as Ramesh was putting it across, the ICDS has to be evolved with an accounting standards. If ICDS gets evolved with an accounting standards, then the commercial issues like what Ramesh was talking about of finance, leasing of a power plant, or airline booking, or collection of discount and gross versus net, these issues will get resolved. And number two, if you can go by the Supreme Court principles on definition of an income, Supreme Court has mentioned income, it gets it characterized as income only when you got a right to receive for performance of services or sale of a product. In the absence of a right to receive and the absence of a performance of a product or a service, it does not take a character of an income when you are merely performing the role of an agent. So therefore, the Supreme Court principles will have to be applied when appropriate accounting standards in respect to certain categories gets notified. The
Right.
the challenges will get widened because the department will look at a particular perspective. The corporates or the taxpayers will look from a typical accounting standard perspective, which is notified. Though this gets notified, the gap will be there. But how to minimize the gap is a matter of challenge in the days to come, Amir.
Right. Right.
I'll be interested to know. Sorry to interrupt you. I would be interested to know how they would at all deal with a situation like service concession arrangements. All of these arrangements on construction of toll roads, toll bridges, etc., where the accounting standard has now come up with the equivalent of IFRIC 12, where you split the construction income and service income. I have no clue, and I'm not sure tax department will look at that sort of substance.
Right. Very interesting. Very interesting. Sir, in fact, my next point was looking at maybe two or three specific tax accounting standards, and keeping tax accounting standard as the centerpiece. Where is the gap between tax accounting standard and our Indian gap, and tax accounting standard and the existing tax provision? So I think next few minutes maybe we could look at two or three standards, and if Ramesh sir, if you could give your perspective on where the gap is between ICDS and GAP, and Sekar sir, the tax law and ICDS, that would be a very interesting all-round perspective. So specifically on the revenue recognition, sir, you talked about how the infrastructure companies would recognize their revenues. I'm combining revenue recognition and construction contracts. Both deal with largely the income determination or the revenue side of it. Sir, are there any significant gaps between the Indian accounting standards and ICDS when it comes to the revenue recognition? Agency, for example, they have fine-tuned from the draft, but any one or two major areas of deviations that you've noted, Mr. Ramesh, sir?
Yeah, take the first one on percentage completion versus completed contracts method. They mentioned, I recall, even for service contracts, it should be on percentage completion method.
Right.
Now, in real estate industry, even in IT industry, percentage completion and completed contracts method are subject to, as I mentioned earlier, a lot of conditionalities. We have a guidance note on real estate which actually addresses this issue in detail, and was actually a deviation even from the international principle of recognizing you on real estate, which in India we felt that the international standard, the then standard equivalent was IFRIC 15, was not appropriate. Now, if I may elaborate, a percentage completion method has got more than two variables, but two principal variables. One is, when do you start recognizing? Whether you reach a minimum threshold of 25% of activity and then start recognizing revenue? And then the second is this concept of providing for foreseeable losses. fundamentally, when you are on to contract accounting, you are required to provide for foreseeable loss. That is fundamental principle of accounting, that you provide for the losses. Tax department is not allowing foreseeable losses. And as you do, even on a percentage completion, you will reach a point where there is a loss on a projected basis. You have to, in percentage completion, constantly project what your future profits are and recognizing a share of that profit or loss. So that is going to get into an area of litigation where you once recognize a profit, and in the next stage of the project, let's say it 30%, you recognize X of profits. When you into the next, say 50%, you may come to a situation you're getting 50% of X minus 40% because your revised projections indicate a lower profitability. I am not sure as to the tax department will be able to live with this. This is one big issue. Forex is another. And whilst on that subject, I have a question in which maybe Sekar will be able to answer, and you tax experts. We have a concept of tax holiday profits, and we have a concept of tax after the holiday expires. Now, tax holiday profits which are exempt, I believe, will then be profits computed with ICDS. I've had rupee depreciate in the tax holiday. 11th year, I settled that forex transaction. All the loss of the 11th year, or is it the loss of the first 10 years when the rupee has actually depreciated? Logically, if you are allowing me a gain or a loss, the hard reality is I'm exempt for 10 years. And the same thing if it's a gain. Let's say rupee appreciates in 10 years, it is not included in level. That is 10 years not on the attack. These are the two large. I'm just highlighting. I could go on and on, but these are the two fundamental ones.
Sure, sir. I'll come back to you on the other ICDS, Mr. Sekar. So construction contracts and revenue recognition in service industries. Your quick comments as to how ICDS would perhaps change the position when it comes to computation of taxes, construction contracts, and revenue recognition for service companies, and then we'll come to forex a bit later.
Yeah, there are two important things when it comes to construction contracts. Construction contracts, even all service companies should also follow the construction contracts principles. Ramesh can correct me. Accounting standards is not applicable for the percentage completion is not applicable for service contracts, but ICDS requires even the service company should follow the percentage completion method, which is a significant change from a service company's perspective, because the question of methodology of completion, what point of time will complete it, and in any revenue contract, particularly in a service contract, there is always a question of client accepting a final product and then making the payment. The question of accruing is always a challenge. So that throws a significant challenge from a revenue service contract. Second point, if you look at, I recognize the revenue based upon the percentage completion contract method for software companies. My tax holiday is eligible only when I realize the foreign exchange. Till I realize the foreign exchange, I am not eligible for a tax holiday benefit. Now, when I do a percentage completion contract method, I realize the foreign exchange. I don't realize the foreign exchange. So what happens to my tax holiday benefit? My 10A or 10AA provision, tax holiday provision is not in line with my ICDS. Second one, in the construction contracts, from a service company's perspective, they say that your provision for contingency losses are not allowable as a reduction under the ICDS. Now, when I recognize the revenue, I have to estimate the cost. It may not be a contingency cost, it may be a expected cost which I need to provide it. Unfortunately, my revenue authorities may take a position as a contingent liability, the normal provisions will not be eligible as a reduction. So I have a little bit of what I would call a conflict between the ideas and the methodology of computation of the provisions of the Act. Though the preamble says the provisions of the Act will override the provisions of the ICDS, but unless the ICDS made it very, very clear that on these provisions, you are eligible for tax holiday, you are what are the deductions or benefits which you are entitled under the provisions of the Act will not get disturbed. That sort of an express clarification should come. Otherwise, we will land up in the area of a dispute. Second point, Amay, if I'm right, you asked about one thing on construction contracts and service contracts. Another point on the construction contracts is that, which is a little bit deviation from India, is probably again I would like to look at from Ramesh perspective. In the initial year period, somewhere the ICDS has put a percentage as, if you are not able to estimate up to 25%, they put a threshold. That means if during the early stages of a contract, if it is not exceeding 25% of the stage of completion, then my outcome of the contract, my revenue recognition of the contract will be according to percentage of the cost which I incur. Whereas in my IND-AS, I don't have that sort of a 25% threshold limit. Now, I don't recognize the revenue under IND-AS for certain reasons, but when it comes to my ICDS, I need to recognize the revenue. Then it was absolutely a conflict, though I don't have to manage separate set of books of account, but I need to keep tab on that. Again, it's a challenge from a tax computation perspective.
Sure. So, Mr. Sekar, just to understand, I mean, one is the area of conflict between the accounting standards and ICDS, but ICDS and tax computation on this point, for example, after 1st April, you might end up paying a tax even though this threshold is not met, and you know, before application of tax accounting standards, you perhaps would have taken a position that the tax is not paying threshold.
Absolutely.
Right.
I could have taken a position because accounting principles govern the recognition of revenue, and there are judicial precedents which says that revenue recognition should be in line with accounting principles. Now I'm little bit deviating from the accounting principles. I need to estimate only for the purpose of ICDS. Though under my there is no income which is accrued in accounting, but I have an income accrued under ICDS exclusively because I'm not meeting the 25% threshold. That's a little bit of a conflict in my perspective, and that's why I go back to the Ramesh first point. Are we taxing a tax on the real income, or are we trying to tax on a notional income, which we believe it has accrued in the real sense it is not accrued? As I said, accrual cannot be different for accounting as well as for tax. Accrual is accrual. That is for accounting or tax. What is accrued in accounting should be accrued for tax. You can't have different accrual yardsticks for tax and accounts.
Right. Mr. Ramesh, before we come to the foreign exchange part, Mr. Sekar talked about the concept of accrual, and some of the fundamental accounting concepts which we also borrowed and applied even in tax were materiality and prudence and so on. And ICDS actually does not make a reference to some of these fundamental principles which are to the core of the accounting, so to speak. Your quick observations, Mr. Ramesh, on this point?
Yeah, two principles I think which they have not recognized. One is materiality, the other is conservatism. Right?
Yeah.
I can understand they are not accepting materiality because in law they may not be, they can't state in law that it applies only to material items. So maybe every rupee matters, and therefore, while in practice they may overlook or permit immaterial deviations. But this principle of conservatism is what bothers me. Fundamental to accounting is you do not recognize revenue unless you believe that you are able to measure revenue reliably or you are able to collect revenue. Now, whilst they talk of this principle of conservatism, in some places they seem to be accepting conservatism, like not recognizing revenue unless you reach a certain percentage of construction activity. So if you're really looking at both materiality and conservation, that should have also been applied, irrespective of the level of percentage you start applying. And remember, accounting standards, even in that, says if you have not reached a substantial appropriate level, you recognize revenue to the extent of costs incurred. It doesn't say you don't recognize revenue at all. Revenue is equal to cost. You don't recognize profits. That's all is the main thing. So I believe the whole issue of conservatism they don't want to get into because it would mean allowing losses on the basis of the accrual principle of expected losses.
Right, right. Mr. Sekar, just continuing with that point, and I'm bringing the foreign exchange principle. Mark-to-market losses has been a great area of debate, even in the tax law. And then we had a Supreme Court judgment sort of approving the deduction for mark-to-market losses. ICDS, in a way, sort of dilutes the Supreme Court observations by not recognizing mark-to-market losses, especially in foreign currency transactions. Mr. Sekar?
Yeah, I was saying some ring was going on, so I was just waiting for that. Hello?
Yeah.
Can I go ahead, Amir?
Yes, yes.
Yeah, this issue of mark-to-market losses or losses on foreign exchange has always been a moot point or a controversy between the taxpayers and their revenue. We thought that after Supreme Court judgment in Woodward Governor, somewhere this position would get settled. And we believed that forex losses on revenue would go as a revenue loss and forex loss on capital would go as a capital loss. But later on, there was a notification from CBDT that mark-to-market loss would not be allowable as a deduction. Somewhere the ICDS has brought this principle through a backdoor that mark-to-market losses would not be allowable as a deduction. And as I go back to the first point, when you talk about the forex contract, we have to wait till the settlement that takes place on forex losses or gain. So when the market losses are not allowable as a deduction, you have to wait till the period of the settlement or period of the contract, which is a long winding process. As I said, I go back, ICDS should not and cannot change the basic principles that are set by the Supreme Court and other courts for computing the income, which has been well established. And unfortunately, on mark-to-market loss, ICDS has got a different standard, which is far different from what the Supreme Court and other judicial precedents has put in across America.
Right. Mr. Ramesh, ICDS 6, the effect of changes in foreign exchange rates, there are some significant differences vis-a-vis the accounting standards that are available. You explained one example of a tax holiday situation. Any other one or two significant
let me give you one. In the interest of time, let me give you one, which is non-integral foreign operations.
Right.
Now, when you translate non-integral foreign operations, the accounting principles require that the translation effect of non-integral foreign operations should be taken to an exchange fluctuation reserve in a way and accumulated till such time of the disposal of the non-integral foreign operation. So it's always taken to reserves, debit or credit. The ICDS says all exchange differences shall be taken to as income or expense. I can't understand this because fundamentally it says that operation is non-integral. It has got nothing to do with me, and therefore it's almost consistent with an ICDS principle of realization that you tax on, that you recognize on realization. Because this is non-integral, it says that marking that to and translating it to an exchange rate is only for the purpose of giving the balance sheet picture correctly and not reflective of the operations for the year, because it is a non-integrated operation. And the real gain or loss arises when you dispose of that operation. Tax, strangely, works on the reverse in this case. They are saying all exchange differences shall be taken to profit loss account. I don't know what they mean.
Right, right. Very interesting. Mr. Ramesh, if you look at all the 10 standards that have been notified as of date, and we've seen also draft for 2 more, on a totality basis, which are the 1 or 2 industries which you think will be significantly impacted collectively by all these tax accounting standards put together, Mr. Ramesh?
Well, all industries which rely on foreign exchange, either for way of import or export, will have an issue, because it will completely unsettle their books, as I mentioned to you, because of the timing difference on realization and marking to market. Second, construction industry, including the real estate industry, in my view, would be hit. Third, the services industry would have a hit, because increasingly in the services industry, there are bundled transactions. The bundled transactions today are inclusive of hardware, software, integration. IT industry also has a lot of that, where you supply equipment and services on a combined basis. And splitting that up, what is percentage completion? I have got a contract, let us say, to install the entire IT infrastructure for you and run that IT infrastructure for a period of 3 years. So I put equipment, I supply software, I get the licenses, I construct the whole infrastructure in place, I run it for a period of 3 years, all maybe for a single price, single value. How is that going to be split? Accounting standards talk of fair value. I'm not even sure tax department will accept that. So in practice, these industries will surely be dramatically impacted by the application of the standard. And quite apart from all of it, in the tax department itself, there is a gap between the law and the administration of the law. Now you give something else where the uncertain administration of the law, it's only going to widen as opposed to the stated objective in the tax standards to reduce litigation.
Right.
So back again, services industry, real estate, construction, anybody dealing with foreign exchange will have a huge issue.
Right. Mr. Sekar, I'll come back to you on this point, but just one follow-up point to Mr. Ramesh.
Because if I may, sorry, interrupt you here, you must remember one other thing. Foreign exchange also has an impact on inventories and inventory valuation and consumption.
Right. Right.
Now, how are you going to unwind all of that if it's only on realization?
Right. Right. Fair point. Sir, and when we talk about the impact, one is the impact on the tax liability of a taxpayer. Impact of this on the financial statements is concerned. The impact will either happen by way of a current tax, which we already know. Do you think many of the actual impact on the EBITDA and the consequential EPS of the companies will get partially adjusted by way of a deferred tax because that gap is still there and we have a deferred tax? Or you think this provision will also impact the quarter one results of the listed companies?
No, correct. It will affect, it will not, it will be mitigated significantly because of our deferred tax accounting. There is no doubt about it. But what will not be mitigated is the interest on the cash outflow of taxation which happens earlier. So the reality business will be paying out cash more. The effect of that payout of cash and the interest cost of that will get impacted.
Right. Right.
I mean, that's a very significant point. I mean, if you look at it, deferred tax may not be up in EPS, but due to this, there's an extra tax liability and extra amount that gets paid. My cash flow and interest will have significant challenge for it. Any corporates in the current.
Surely. Yeah, I mean, the impact is at two levels. One is at a cash flow level, and other is at a your earnings level. But Mr. Sekar, specifically, a collective impact of ICDS to a tax rate and a CFO. What will be 2 or 3 significant challenges, and what are the immediate areas of focus that are required looking at the way ICDS have been notified, Mr. Sekar?
Okay. The way I look at it is that after the notification of ICDS, department will certainly ensure that ICDS are being complied with the company's taxpayers when they file the return of income. So either I expect that there would be additional disclosure requirements in the return of income, or I'm not so sure whether the government will add on one appendage or one more tax appendage to the tax audit report, whether all the tax accounting standards have been followed up or complied with the company while determining the computation of income. If any of these two things, either of these things is certain, only which form you need to look at it. At the end of the day, the government would like to get a confirmation that all the ICDS have been followed up. If that's one of the things is going to come up, then the compliance side for a CFO is going to get higher. He is not only to comply with the corporate ICA accounting standards or the NACAs or whatever it is, he has also to ensure that tax accounting standards will also be complied with while computing the computation of it. That's the first bigger compliances. The second bigger issue for any of the CFOs or the tax kids is to keep identify the differences between the ICDS computation versus the book computation. Earlier we had, when US GAAP was introduced, a lot of corporates used to follow the reconciliation between the US GAAP and IGAP. Now, largely I may foresee there could be a reconciliation between the profit as per ICDS and profit as per the IGAP. What is the reconciliation item that will get thrown out, and you need to keep tab on the reconciliation item. That's point number 2. Point number 3, as Ramesh was putting it across, if the company are very, very significantly depending on foreign exchange inflow or outflow, be whatever it is. I expect a significant inflow on forex business, forex contracts through my customers and through my service income, or I'm largely depending on the forex for my imports or to my construction business, a huge capital. Then the reconciling between the foreign exchange losses, estimated losses versus settled losses, estimated gains versus settled gains, component of foreign exchange with which we got to which business, which services. This is going to be very, very critical, and to that extent it leads to complication. And the last one, which I believe which may impact of any CFO, is that if I'm doing a transaction which are bundled transaction, like Ramesh was putting it up for software and hardware, sale of ticket versus discount, sale of ticket versus coupon, sale of a product with another discount coupon, where I'm doing a bundled transaction, revenue recognition of the bundled transaction and the expenditure recognition of the bundled transaction could become a challenge in the days to come. And these are all the 4 broader areas which CFO may have to get into across.
Mr. Ramesh, would you like to add, do you anticipate more issues for CFO tax heads in the coming months after ICDS?
Yes, without doubt. I would say ICDS is nothing but income computation distortion standards, or income computation disruption standards, if you may like to rename those. It's completely going to, as I said, in India, it's not a problem of law, it's a problem of quality of administration of the law. And look at it in the larger context of India. We have 700,000 cases pending in Supreme Court, 4 million cases pending in High Court, 31.5 million cases pending in lower courts. You can imagine the cases pending in tribunals. And we're going to add further to this clogged pipeline of cases. When do we get resolution? We first need to get certainty into our own thing, not through this mechanism. And this is good. And look at the challenge for a CFO. For a CFO, he's getting a new framework of accounting, which is IFRS equivalent, which is going to take it to a completely different level and perhaps widen the gap with ICDS. He is faced with ICDS in the taxation issue. He may be faced with GST, which is coming in. He'll be faced with the direct tax code, which is coming in. He has the challenge of I know, when I've said direct tax code in a different forms, whichever you may call, you have got your BAPS, you have got GAR, you've got POEM, all those things will come in some form or the other. It's like what sometimes we were thinking even in IFRS, if we don't bring the whole IFRS as a basket, individually correct all standards equivalent to IFRS, you will not know. In related party transactions. Virtually everything a CFO was dealing with on a stable basis is completely changed. And I think it's a nightmare for a CFO. And there was no reason for ICDS now. One could have waited for ICDS for the new accounting standards to have come in, which is effective 16-17. Looked at the ICDS in the context of the IFRS regime and seeing what we need to do.
Right.
Now it applies to the current Indian standards too.
Yeah, absolutely. So perhaps one more revision, re-looking at some of the standards in future. Mr. Sekar, your concluding comments on ICDS and 10 is a count today. Do you think government will come up with more standards and try and bridge the gap between Indian GAAP and ICDS?
No, before he answers, their tax department, as you know, always comes up with alpha suffixes. So there will be 1A, 2A, 3A, 3ZZ, all those things will come in. As Mr. Manoharan would say, said at one time, it used to have 80 IO, 80 IIO, he would say. As in Tamil they say. So like that it will happen.
Right, Mr. Sekar, your concluding comments?
Yeah, I could see a lot more tax accounting standards coming into the days to come. But if there is a realization on the part of the government, this tax accounting standards is not going to any way help the government on the tax administration, then probably the government should not introduce any accounting standards and should withdraw it. The government aim is to for simplicity and make tax administration more robust. Then the government should not introduce any tax accounting standards. They should make it very, very simple. All accounting standards introduced under the Companies Act should be followed for the purpose of tax, then life makes simpler. But I'm not so sure whether anybody wants a life to be so simple. So therefore, I expect more accounting standards of tax. Probably the entire draft accounting standards which are introduced at some point of time will get notified over a period of time. That is what I personally believe. That's what is days to come. And as he said, is a days of conflict between, earlier there is a conflict between the Income Tax Act and the accounting principles where it got largely mitigated. If you go back when it started with cash accounting, then mercantile accounting became accrual, and last the question of prior period and contingency, everything was almost getting settled. And after the introduction of MAT, the question of different accounting standards per se does not arise because most of the companies will follow the MAT profit and pay the MAT taxes. I am not sure what is the relevance of tax accounting standards when the effective rate of tax as per the government own estimate is 21%, which is just above the MAT rate. When everybody is paying a MAT tax rate and MAT rate, where is the need for a tax accounting standard? And I need to comply with the accounting standard as per the Companies Act. That's way, though nevertheless all these points are good, but unfortunately the way it is that tax accounting standard will come into play in the days to come. Amaya.
Right. Mr. Ramesh, your
Two quick points. Yeah, two quick points I'll make. One is, I'm apprehensive that this is the beginning of further, shall I say, laying down of standards or further prescriptions by the government in every area. Now, in the area of excise or VAT or other areas, I'm sure they'll come up with some sort of prescription on how valuations are to be done. That is what scares me. The second is, it's going to look at where we are heading as a country. We are going to have, assuming that we are all what the Prime Minister says is going to come true, we are going to have a hyper level of M&A activity. Now, when you have a company which has a gap between its ICDS and accounting and nightmare in keeping track, imagine when you merge those entities and the merger values get accounted for differently in the transferee entity. Where are you going to keep track of all of that? Or the demergers which happen? How are you going to segregate all of this in the effect of the demerger from a tax point of view to the various entities? This is something which I have not, I can't, envisage at this point in time in terms of complications.
Right.
But I'm always worried about initial actions which become subsequently magnified onto a different scale. When the door is once opened for the government to enter, or in this case the tax department to enter into laying down standards in an area which is not their core competence, which is not their expertise, then once you've allowed that, they would be able to, then you are allowing every other agency to lay down standards beyond their core competency in areas which are not relevant for them.
Yeah, fair point. I think
a concluding point from me, Amaya, when you have prescribed a MAT rate and book profit, where is the need for tax accounting standards? Absolutely not required in my view.
Fair point. Two key takeaways. I think foreign currency operations, the impact needs to be carefully assessed, and managing the transaction and compliance, that's the next headache for CFOs and tax heads. Thank you so much, Mr. Ramesh, Mr. Sekar, for sparing your time and sharing your perspective analysis. It's indeed very interesting. Thank you so much.
Thanks.
Thank you, Ramesh.
Thank you. Thanks, Ramesh.